As introduced, I'm Sherry Madeira with the City of London, Special Advisor to Asia, which is an incredibly big patch. But we're going to try and concentrate on this panel on China and indeed the Belt and Road Initiative. Now, I don't think that narrows it down any. In fact, I think that makes it even bigger, but we're going to see how we can work through that. I will definitely leave a substantial amount for questions at the end, because I hope that we can start drawing out from this very knowledgeable audience as well some of the concentration points that we should start thinking about as well. So what's left to me is to first very quickly introduce our panel and kick us off. This is Ada Sidakova, the Director of Energy and Natural Resources for Russia, Central Asia, and the Caucasus for the European EBRD. Rongrong Ho, who's been referenced in previous chats this morning as well, but the woman who knows about green and RMB for HSBC. Rico Zhang from ICMA, based in Hong Kong, so a pleasure to have you here with us in London, but also incredibly well connected in the entire patch bridging China and the rest of the world, particularly in the bond market. So thank you all for joining us. I'd like to start with you, Rongrong. We've talked a lot this morning about generally green and how that has been developing in terms of global bond markets and particularly the Asian bond markets. But perhaps you can give us a view of some of the existing challenges and thinking about some of the new challenges in the context of as China pushes out towards this extensive Belt and Road, 65 countries, such a big patch, but also such a big opportunity.
Thank you. Okay, thank you very much for the opportunity. So if I may, I'll just start by how we view the Belt and Road Initiative and how does it fit into the existing, global infrastructure push. So, we talk about the currency development, we talk about China's capital markets, leadership in green bonds, etc. But let's be clear here, whether it's a bond, it's a loan, or some funding, structuring, etc. For us, they are enablers for us to get to a positive outcome. So the way we look at China's Belt and Road is an infrastructure-led, multi-dimensional, a very long-term initiative. And the way we look at China's role here is that it may seem to be like China-led, a solo play thing, but really it's a global initiative. And it requires lots of people, in different parts to work together. And previous panel, you heard what the multilateral development banks, such as IFC, is trying to do, and the government's push, and the individual banks, and clients and corporates in general. But the way this time, why it's different, is China's Belt and Road is using a different strategy, i.e. capital go first, then ultimately driving the trade flow. The existing, financial products, whether it's bonds or, equities, etc., they are a secondary outcome of a primary market solution. So very, very important for us to see that. Now, Sherry asked us to remind ourselves what are the existing challenges in the global infrastructure space. Infrastructure as an asset class has been talked about it for decades. It's hardly new. There are existing challenges, as we heard this morning, a lack of, despite some that, don't get me wrong, there are progress being made, primarily in the developed countries, in particularly around Europe, but there's still a sense of urgency in terms of lack of quality and bankable, projects. Capital, when we speak to our clients, whether it's, investors or other banks as peers, capital has never been an issue. And everybody realizing that public sector money is not enough. It looks like so far we have new players in town, the AIIBs, the new development banks, and China has its own, solo funds, such as Silk Road, etc. People thinking, oh great, we just rely heavily on China. Let's rely heavily on other type of public sector money. The reality is just not sustainable. Sustainable in a way is not going to be recycling to do volume. It's not going to be, efficient for driving volume. So we need the private sector capital coming in. So the second existing challenging for, global infrastructure is there is a mismatch between the political cycle as well as the investments capital cycle. And let's be clear, the third challenge is we need to help private sector capitals making money. It sounds terrible, but in a political way is we need to understanding the right risk versus the right return. We're talking about long-term investors such as pension and insurance. These investors are not going to put money in there just for the sake of it. They need to make sure that they achieve the right return. The last but not least, they want to make sure there are efficient solutions to help them mitigate the political risk. Let's look at the Belt and Road initiatives. Those countries, I don't know how you guys look at this. They're pretty tough countries, right? I mean, lots of them are really, really difficult. So how do we rely on those governments and partners are very, very important. Those political risks are core. Actually, if I may, we were really proud to be part of the City of London initiative. Sherry actually chairing the Greening Belt and Road. So the new challenge for us is how do we make infrastructure sustainable? I don't know if Peter is still here. I think Peter is. So, if you think about corporates like Arup, they are exactly the partners for us to learn and then work with. These are the people actually can make infrastructure both at the initial phase, greenfield, as well as the operational phase, which is ground and mature stage, sustainable. But at an economical level, it's not just about feel good. It's actually generating good money. You got James as well, leading the strategic initiative for Arup. But things like this, rather than just focusing on something, oh, let's get there, let's think about what to do, let's think about get it right at the first place. So the green or sustainability become an overarching challenge or theme for us all. We do not yet have the answer. So hopefully, Sherry's leadership on this, setting up the Investor Alliance, and actually bring the Belt and Road at a green level can really help all of us participating and do further.
Great. Thank you, Rongrong. And that's a fantastic lead-in to telling you about sort of the greening the Belt and Road concept. I was with Rongrong and Michael Sheeran and others, Sean Kidney, in Beijing last week to launch the GFI, Green Finance Initiative, and GFC, Green Finance Committee, joint task force on multiple topics. I was very proud to be able to lead the one on greening the Belt and Road. And one of the very, very clear recommendations that came out of that in terms of our industry consultation was the need for an investor alliance, something that had investors from all phases of an infrastructure life cycle speaking the same language for green, and obviously working very closely with Sean and others in terms of getting that global definition sorted as quickly as possible. Is important to make sure that governments are being able to sign up for that and some of the key government bodies. But it is equally as important to make sure that investors through that entire life cycle also agree to those same definitions. Because the risk here is not only that we end up with new brown infrastructure projects, which I think we've covered fully this morning, which is obviously no one's interest. However, there's also a real risk here that even if you think you're starting green, you may be creating an infrastructure project that takes decades, that indeed becomes a stranded asset, because that definition of how it is you're going to finance it changes from an MDB to a private bank, to some of the governments involved, and finally some of those long-term investors like pension funds and insurance funds. So the City of London has picked up the baton from that recommendation and is creating a Green Belt and Road Investor Alliance, which is not for companies based in London. It is an initiative that includes global investors. Being a global financial center, that's the best way of making sense of it. We're putting out some of those terms of reference in the coming weeks, so hopefully we'll be able to share that in more detail as it goes forward. But the real tenet is making sure that harmony starts not only happening across as many of those BRI jurisdictions as possible, but also as many of the investors who are going to be part of that life cycle, to ensure that we've got some sustainability in terms of green definition, but sustainability also in terms of sustained finance. Perhaps we can turn to ADA. And ADA, often we start thinking about the Belt and Road as being a China-driven strategy, that Asia is where China first touches other countries along that Belt and Road. But the reality is it touches Eastern Europe, the Caucasus, Russia. I was at the Belt and Road Forum in May, and the second speaker after President Xi was Putin. So Russia is a really key part of actually this initiative going forward. Can you share with us from EBRD's view, maybe some cases or some thinking along that end of the Belt and Road?
Absolutely. I mean, the EBRD has embraced the ethos of OBOR, the Belt and Road Initiative, fully. China became a shareholder of the bank last year, and it's really in our fabric to combine the green financing part, be it through bonds, because we issue bonds as well, green bonds, but also on the demand side, to combine that part. Every investment in EBRD has to some extent be green. We have a target of 40% by 2020 of all our investments being green. So combining that part with the policy what we call policy dialogue in engagement with authorities in the countries where we get involved. Of course, our countries, our region of operations is on the front line of the OBOR. It's Central Asia, it's the Caucasus, it's up to Balkans, Eastern Europe, and further up. So it's really there that we would like to see more of Chinese sponsors coming and investing, not just Chinese as well, but across Asia. We think that there's enormous appetite and potential. Case study is Kazakhstan, the country that is rich in coal, cheap and very polluting lignite coal-based capacity, generation capacity, but which makes a conscious effort to switch to renewables, not necessarily leapfrogging transition fuels like gas, but combining potentially gas and renewables. Again, this country doesn't have, thinking in isolation, doesn't have to do that, but there is an effort, there is a regulatory regime that is conducive to investments like the bank is doing. Unfortunately, we've been so far the only IFI who's been financing renewable projects in solar, wind, and hydro in Kazakhstan and Central Asia. But we hope there will be more MDBs coming, there will be more private investment coming. You mentioned on public finance, we think we are, as a public institution, strongly encourage private investors, crowding in commercial banks, crowding in developers, crowding in larger corporates who all might be interested in the enormous potential that Central Asia and Caucasus could offer. So what we see on a general scale is that there is an issue of scale, reach, and urgency. And that's where the bank is hitting, we think, all three nodes. I mean, to the extent, given the size of EBRD and given the region, we think with Chinese investment coming, we will be able to help to contribute to the scale part. We'll be able to increase investments in renewable energy. And renewable energy is the driving force of decarbonization. So this is, as opposed to some other sectors, for example. So generation is responsible for greenhouse gas emissions pollution, but it also could be a tool for decarbonization. Second is as I mentioned, the reach. It's all countries, not just big players, that have to contribute to that. And third is urgency, that the first panel this morning stressed very well. I mean, we don't have much time. So the bank is very well aware of that. We've been involved in the first large-scale solar projects in Kazakhstan, done subsequent investments. We work very, very actively in the Caucasus. And we have to say that there are risks, of course, things like regulatory regime, lack of financing structures, lack of financing sometimes. Long tenors are not easily available. And that is being solved to a certain extent in places, again, like Kazakhstan. Astana International Financial Center, an entity or a structure that's been created with the help of the EBRD, has green financing at its core. So we do hope to help Astana International Finance Center develop its green products, start offering bonds, localizing international standards, and actually creating a network for investors, financial institutions, and other providers of supporters of renewable energy.
Thank you very much, Ada. And I think your point about crowding in is really essential here, because there is no way even a portion of a Belt and Road infrastructure plan can be successful without that really clear transition and the efficient use of capital. So EBRD or other government bodies may be able to step in for that first piece, which I think we're all quite realistic that that is going to form a key part of developing this. But if we aren't able to also release that risk funding to be able to reinvest in the next project, then we're really not making most efficient use of capital. And Rico, I'd like to turn to you about that capital and trying to find ways of trying to sort of bridge some of those cross borders. I know, Rico, you're quite involved with thinking with NAFME on the internal bond market in China, as well as thinking about, is there such a thing as a BRI bond? Is there something that starts saying that there is an asset that's defined like that? And indeed, then the mind starts to boggle, doesn't it? I mean, you could have a green BRI bond, you could have a green panda BRI bond, you could have a, conceivably a Masala green BRI bond listed on the London Stock Exchange. But I mean, what's the practical future, do you think? And where do we need to go in terms of steps to get towards something like that?
Infrastructure financing actually is a universal thing. It's very important not only in Asia, but also in EU and the US. So back to 2015, we published an infrastructure financing guide in Europe, which is updated this year as well. And also we published an infrastructure financing guide in Asia last year. We have some key findings. So definitely the private capital need to crowd into the financing demand. And right now we have bank loan, private placement, and obviously the bond market available for such purpose to get to the private capital into those projects. And obviously it's very challenging because for different reasons, particularly with the Belt Road countries, we have different risks like political risks, geographical risks, project risk. So one key issue our members or the stakeholders find is the risk allocation. It's not fair to have the investor to bear all the risks. And also if you don't fairly allocate those risks to different parties, those projects cannot be successful. I want to touch upon the capital market particularly because we obviously setting standards for the capital market. Bond Connect actually is very good for the infrastructure financing because we have a lot of long-term investors such as insurance companies and pension fund who are looking for long-term assets. So infrastructure actually match those demands. But again, the risks and et cetera. And also, we don't have a very robust capital market in Asia, not like in US or EU. The general capital market is really developed, and those investors are pretty sophisticated. But in Asia, it's a different story. We have developed capital markets such as Japan, Hong Kong, Singapore, but also a different domestic market. They are not that developed to match such financing demand. Like within ASEAN, we know Indonesia is the biggest country in terms of population, etc. In ASEAN, they have huge infrastructure financing need, and basically they cannot get such money through the domestic market. So what they're gonna do to basically look to shift to the those capital market. With the Belt Road initiative in place, now people eye on Chinese capital market, which particularly after the Belt Road summit in Beijing, the Chinese authority makes it very clear that it welcomed such issuance just gradually to tap the onshore market. We know Panda bonds, labeling actually is a very important thing because it basically can get like wide attention from different market participants. So why we label like a green bond, Panda bond, but also it's confusing. earlier, like last year, we received some sort of like request from one of our members that maybe we explore the idea about Silk Road bond, which again, the Belt Road bond. But what that means, ideally, it's for infrastructure projects along the Belt Road countries. Now, people will question, is this necessary because we have just too many labor lanes already? Yes and no. Yes is, again, because people are going to aware that what their money to put into. But no is, it's just confusing enough to the investors that what exactly the projects my money will get into. So just to put things simple about the international market generally and the Chinese onshore market. From the issuer side, we all know the Panda bond, right? This is a very obvious vehicle for foreign issuers to tap the onshore market, mainly in the RMB asset. So we already seen the first Panda green bond by New Development Bank last year. Even in the industry, people even want to develop some like a slogan, image. It's a big deal. People will just draw like a panda wearing a green hat. Then for Chinese, green hat actually is a bad meaning. It's meaning just your wife cheating on you. So that's also the culture difference. So we just drop it. But again, it's interesting that people will see to combine green characters into those bond products or projects. So, like I said, like I mentioned earlier, now the Chinese market welcomes such issuance to tap the onshore market. So I would expect more and more Panda bond issuance along the Belt Road countries, no matter it's a sovereign, it's a corporate, financial institutions, particularly the financial institutions, because they allocate money through the bank loan to those projects as well. So they have a very strong portfolio to back up their financing to those, allocate their loans to those particular projects. So we all know like a Chinese green bond market is the biggest one last year and will to continue this year. The biggest portion of the issuers actually is the banks because of their bank loan portfolios. So I would expect that those financial institutions will be very welcome to tap the Panda bond market. From the investor side, we all know the Bond Connect is launched this July, and so far participation is mainly from Asia. A lot of European and US asset managers are still looking into this and haven't decided if I use this channel to tap the onshore market or not. But the green actually is a very unique example people are going to think about when they want to invest into the onshore market. Because in the last panel, people argue about the definition about the green, but I can really honestly tell you, green actually is the most consistent concept between the international and Chinese market when we compare the two. Back to like a couple of years ago, we worked very closely with the onshore regulators, including People's Bank of China and the NAFMI, to develop the green guidelines. So the first Chinese green bond guidelines is published by PBOC in December 2015, which actually is the reason why we have seen just a huge growth in 2016 of the green bond issuance. The whole concept, the whole guideline is very consistent with the green bond principles, which ICMA manages. The total system, like you tracking the money, reporting, which the Chinese standards are even stricter, because as a green bond principle, we state that actually you need to report like every year, but right now the Chinese regulator make it every quarter, which is stricter than the international standards. It's just the argument about the definition of green, meaning the clean coal. Setting that aside, I personally feel very comfortable to invest in any green products in China. Also, they make it strict, like even the wording. We know the certification is a big deal for the green bond because you need a third party verify to endorse that this is actually a green. In green bond principles, we shift a little bit from the 2014 version to 2015 version to 2016 version, basically changed wording from encouraged to recommended. I'm not an English native speaker. You tell me the difference between the two words. But basically, the Chinese copy paste as such, it's even say encouraged. As a Chinese, I feel very surprised because usually the regulators would just say, do whatever I want. So unless you have a third-party professional to endorse you have the green product, I won't give you approval to tap the market. But actually, they carefully review what's going on at the international market and copy the standards used at the international market. So again, they look this in a very important deal, and international market feel very comfortable to invest into the Chinese market if it's a green bond. So one thing we now explore, I would say maybe at this stage is an idea, like labeling more about the green bond in the Chinese market to further make the international participant feel comfortable to get into the onshore market. So when they want to use the Bond Connect to invest into the onshore market, maybe green bond is the first choice they can consider. The labeling actually is a huge task. Again, it involves different stakeholders, it involves international participants, and also onshore regulators and others. So it's not easy. I won't, say when that could happen, but definitely that's the right way we should explore.
So to make sure that we all have a time to quiz you afterwards as well, because obviously Rico knows quite a bit about the onshore market in China as well. But what we're trying to find is a way to sort of make a most efficient use of capital. So obviously the green bond market within China is growing. The access to it hopefully will continue to grow as capital accounts move, et cetera, and change. But I guess the question that's also raised is China has just bequeathed to Exim Bank, CDB, Silk Road Fund, a huge amount of specifically Belt and Road focused monies to be put into place in RMB. So if we're starting to think about sort of how we can ensure that there's a green principle that is looking at some of these projects, I mean, how is it that we can make sure we deploy those funds, which are obviously being controlled by Chinese interests, into a globally accepted green implementation outside of the borders of China? And how does currency get involved in that? We were talking about issuers going into China and issuing green panda bonds, as adulterous as they obviously are with the green hat. But perhaps, how does that work in terms of cash flows? And when you think about the infrastructure projects happening elsewhere? Wrong. I mean, obviously, you've had a hugely, massively long background in RMB, thinking about dim sum, how it starts crossing borders. I mean, where are the challenges we need to think about there?
Sure. I mean, thank you. There are a few things. I mean, let's be clear. The domestic markets has been gradually open. Associations like ICMA has been really doing a lot. But it's still very, very slow. So when we talk about a panda bond, we talk about a bond raised in China, but primarily should be used in China. And then, there are different regulators. That's why the previous panel, the IFC, despite how much they wanted to be, issuing, but they couldn't, partly because there are soft issues involved, the accounting rules, the legals, and the language, etc. But so far, if you look at the true panda issuance, I mean, it's really like Daimler, quite a few years ago. So having that consistency around legal and accounting may not seem to be such a big thing, but it's gonna really break, really increase the issuance volume. But if you think about in terms of going out, of course, the currency journey, for those who started following, really taking off here in 2011, but things in Asia, back to 2008 and 2009. I hope you now know what the R&B is, because there's still people talk about R&B as a music industry, like that R&B. So after 5 years, I was hoping that, people get that right. So the currency journey, despite now, is very much like a business as usual, certainly from a bank's perspective, but it's going to be a painful but slow journey. Why? Because you can't really having a currency that's international but then still controlled somehow one way or the other by the government. You really cannot have two markets when you're trying to be a normal currency, right? You still have the onshore and the offshore, which is outside China. The inclusion of renminbi as an IMF currency, so SDR currency, is a very big step, but be careful what you wish for. You really have to let the markets determine what does it mean, both from FX interest rate as well as capital account liberalization. So going out is China's long-term strategy to use it, but the hedge, as the recipient country is very important. Because you could argue, so why do you need renminbi? Well, that's the base currency. You have lots of participants from Chinese, therefore they could be happy to receiving their wages, paying the labor as well as the construction costs, the material, etc. But let's not forget that domestically, the home currency is very different. This is also what we want, is to have the help from the public sector money. So for example, India may not be part of the Belt and Road, but if you think about the huge demand from India, the investors that are sophisticated, they make it very clear they're happy to take on the project risk, they're happy to take on some of the liquidity risk, but not the currency risk, right? They're happy to work with the Chinese, but they need to be very sure that they receive regular income in the currency that suits them. So this is where I think banks like HSBC can help. The Asian development banks, the EBRDs, the World Bank, they can all facilitate in the middle to create a hedge, risk management strategy that allows the investor participating in and also bring the corporates together throughout the life cycle, which is very, very complicated if you think about 10 to 15 years of infrastructure cycle. So, and that's why we love it, because we like all the things that are confusing. But the way we look at it is that we are a little bit better, because when you deal with a consultant, they will charge you for an advisory fee for helping you just navigate the confusion. No, I'm joking, that's fine.
Great, thank you, Rongrong. I'm just going to ask Ada about sort of stepping in from a practical level about how it is that you do partner with China, or how do you see potentially partnering in the future, and how some of these risks or challenges that Rongrong has placed, the currency, ability to hedge, ability to make sure that there's a full cycle. I mean, how's that your view? And then I'll take it to the floor, so prepare your questions.
Well, in our countries, specifically at the front line, at the doorstep of OBOR and China, it takes a village to raise the renewable sector. So all sources of financing are welcome and would be welcome. The question is, who is ready? We see, and I echo Rongrong's issue on the FX exposure. In countries where the feed-in tariffs or prices are in local currency, developers need local currency financing. This is what we face, this is what we've been working on and trying to provide. And now they want in those underdeveloped capital markets. So tenor is another big issue that we see, longer tenor that is matching the nature of infrastructure, assets that were being built, matching the duration of PPAs that are available there, is another question. A regulatory environment for financiers, for individual developers is a big question mark. But I think it will take a concern, there's a political will, I'll repeat myself, and this is something we should be capitalizing on, and it's across the range of development from Kazakhstan to Tajikistan to further up to the Caucasus, where Georgia is becoming a new beacon of renewables. Chinese sponsors certainly are starting to come to these countries. We see some interest in Kazakhstan, but it's really, given the sheer scale that is next door to Kazakhstan, we would like to see more of that. We would like to see more investors coming. We understand the risk averseness of individual developers jumping into this unknown market, but that's why, for example, EBRD is there for. we sort of implicitly take on the political risk. We work with the governments on establishing a level playing field for everybody. So this is what we think should give some comfort to investors, including Chinese investors.
Thank you. As promised, questions from the floor? James. Just here. Your mic's right behind you.
So, well, thank you for that. That was a great presentation, covered a lot of the challenges. One of the challenges I'm more interested in at the moment from a technical point of view is perhaps the ratings in terms of differentiating between types of green, and what you see is how that challenge will develop and where the convergence will come to actually try and create a more kind of the environment where people can have confidence when they invest in, whether you call it Belt and Road bonds or green finance bonds, how they're going to be able to differentiate that, and what the story of that convergence looks like going forward.
Yeah, I think it's a really complicated issue. I'm going to ask Rico to comment, but from our recent research that we published last week, some of the comments from the investors were that actually, if you talk about a Belt and Road bond or a Belt and Road financing product, you are going to be talking about this for decades. And in fact, having that range of geopolitical risks, as Ada mentioned, the currency risks, and also just the different types of infrastructure that could be considered in this. It's not just roads and rail and ports and airports. It is also communications technology, water treatment plants, it's energy, it's renewables, and creating a apple-to-apple comparison that you could say this is a BRI funding product, which hopefully inherently will be green, but at least a green BRI product. It's almost a hiding to nothing. And so perhaps there needs to be, and this is the input from our original survey was, it needs to be a smaller universe first as perhaps phase one, and then that starts getting phased out so that there's a possibility of realizing this ultimate dream of infrastructure as an asset class, green infrastructure as an asset class. And what do we really mean by that? And I'm looking sort of at Jess from the London Stock Exchange back there, so that it becomes tradable. So not just as a primary vehicle, but that it becomes a secondary vehicle as well, so that there's liquidity there and it moves forward. That's from the initial research we've done. I think that there's a logic there that actually almost takes a page from the Chinese saying of crossing the river by feeling the stones, and maybe that first stone needs to be a subset, both in terms of geography and infrastructure. But again, Rico, maybe you have some comments to add on that.
In infrastructure field, rating definitely is a key to help investors identify all the different risks and help particularly those long-term investors to invest into those products because they have mandate to invest in IG bond. Credit enhancement, the guarantee are very crucial. So NDBs, local governments should do something in that area. But if that product is already rated pretty high, we actually found that you need to strike a balance between the two because some investors will prefer high premiums. You don't have to give further credit enhancement to make sure that their bonds are rated very high and actually the interest rate not that attractive. In the green space, actually, it's already very developed. No matter in China and internationally, we know certain rating agencies already put their green factors into their credit rating as well. Because if you track the bond performance first, set the primary market first, you don't see a really pricing advantage if you compare a green bond to the vanilla bond. But actually, at the secondary market, the green bond actually perform better than the vanilla bond. One of the reasons actually is you don't have the downside risk, like environmental risks. So basically, green matters. So now a trend is the rating agency put the green factor into their credit ratings. That's the first. Second is like a Belt and Road initiative. The whole thing is very complicated. No one can even define or identify the whole thing. But one effort within the rating agency, as I know, is there's sort of like an Asia local group of the different rating agencies for their domestic market. They just put together want to develop some standards to cover the barrel countries, which is not a strength from the international big three. So those local rating agencies, they know better about the risk, they know better about their domestic market, so they're going to put something together to help rating with those projects, even green, to help the capital market to get such financing to those infrastructure projects.
Thanks, Rico. Wrong.
Thanks, James. So where we are seeing is that if you think about what do we mean by green rating, and done by what? So as Rico said, in the market, you have the mainstream rating agencies and other, specialized rating parties. But in the green space, it's very much like an interesting dynamic, i.e. you have quite a few specialists, and they have that environmental or somehow, if you look at the trend, right? So I think people in the room hopefully will recognize the importance of E, right, which is environmental. Outside the room, who is driving the dial is investors. They are really focusing on three elements, which is E, environmental, social, and governance. I mean, that is actually quite simple but quite complicated three names, because within the three things, we do not yet have the commonality. And the sector, different sectors have a different material risk and different assessment methods. So in terms of the providers in this space, people are trying to leveraging their USP, but ultimately we will see either a painful or nice, joyful consolidation. Because if you look at, the Trucost, for example, they were one of these assessment party, and they bought by S&P, back to last year. And just a couple of months ago, Sustainalytics, 40% of their, company was bought by Morningstar, who is a rating agency for funds, etc. So we are seeing quite a few interesting dynamic. The big guys, like Rico said, despite the three big rating agencies said they already incorporate, ESG into their traditional credit assessment, they got a bit of a long way to go. But we are working with them, and they are quite serious about this. We actually have a real evidence about the ESG actually accumulated financial impacts on asset classes. Actually, James is one of the contributors as well. I would, if I may, to encourage you to have a look at this City of London UK-China Task Force. There's a report just launched on the 4th of September, has 5 work streams. The first is the environmental analysis for institutional investors. Second is the green loans and green securitization. Third one is the impact of ESG factors on cost of capital, which is both on the rating, on the return as well as the cost of funding. Fourth one, greening Belt and Road, and the last one is led by Sean Kidney on the bond side. They're actually quite really interesting content to read. I mean, it's by all no means the end story. It's really a journey of evolution.
Thanks, Ron. Question, yeah. Sure.
Thank you. 2 points. The first thing is that most of the green developments will require some form of subsidy from state in the form of a feed-in tariff. Obviously, that level of tariff will vary from country to country relative to the input costs of the comparable fossil fuel elements. So therefore, you won't be comparing like for like within a bond structure. And secondly, it is logical to my mind anyway, that if you operate in Kazakhstan, the bond should be issued by Kazakhstan rather than by China. But yet the ratings issue for a bond from China has a much better prospect than the one from Kazakhstan. I don't mean to insult anyone from Kazakhstan. And so therefore, this mismatch continues. Is there the opportunity to rule out some of these issues by having uniformity with a feed-in tariff throughout the entirety, a set standard throughout the entirety of OBOR? And is there the opportunity for maybe a Chinese wrap of the maybe weaker covenants of the recipient states of OBOR?
Excellent concept. Perhaps I can turn to Ada.
Yes, just on the feed-in tariffs and the subsidy level that are implicit. What we are seeing globally now is that the countries are switching to the auction system, which is more competitive and price signaling arrangement. We're seeing enormous drop in prices as a result of that. And I mean, places vary from Chile to Mexico to India. This is what Kazakhstan wants, for example. Kazakhstan wants to take on as something for their own consumption. They want to establish an auction system, shift away from the feed-in tariffs that were set about, say, 4 years ago, with very high levels of subsidies initially. We were in a lot of investors, unfortunately not so much of specific projects realized yet. But the government think that they could provide sufficient comfort and justification for an auction scheme. That would mean that there are investors coming, that the cost of renewables is dropping compared to the thermal generation. There is grid parity achieved in many countries, we know already. So coal is not obviously an answer. In terms of how this could be financed, well, it's the Kazakh government is looking, I think, again, and we support them in that, in a variety of financing options. In places of the whole OBO route in our region, it would take, again, I repeat that, I mean, it would take IFIs, MDBs, it would take bond capital markets, it would take investments by the governments themselves. But what we see is that the interest, I mean, the financing is just part of the story. There has to be an inherent structure that is conducive to investors for the underlying projects. How the auction scheme will pan out in this sense, and where's that level of return that investors will be getting. I mean, we see amazing numbers in the Emirates. I mean, people are very happy with prices as low as 3 to 0.6 cents per megawatt. This is incredible. And we think Kazakhstan wanting to have that level of price will have to do certain things, but it's doable. And once they have an established environment, the financing will come. That's.
And if I may, on the second point, I mean, your logic is really understandable, but lots of the countries along the Belt and Road, they are really small countries, and their ratings are really not quite there. And we all know that if you are AAA rated, you have a much better funding cost, right? I mean, if you think about a long-term and really cheap cost, you know, you have the supply of access capital and capacity from China, who may arrange a zero interest rate loan. We don't know, always the case. You know, why not? You know, why wouldn't you? You have that initial phase, but as the previous panel and you know, the EBRD lady said, we have to leverage in the public sector money. It's no point of just putting money in, because this money actually come from members or countries. They are not actually free. They are probably our tax money as well, you know, in some shape or form. So it's very important that they're providing that cushion so that, you know, I mean, commercial banks have a constraint. We are Basel, you know, controlled, therefore our money is arguably not long-term. But if we can find the right structure, you know, like Rico said, get the risk and return right, maybe investors are willing to do so, understanding what they are, you know, sign up for. And hopefully, you know, after a number of years, we can actually refinance and doing the right thing for scale.
Would that not lend itself more to a debt equity structure initially rather than bond?
At the beginning, it's IQT play. I mean, in a simple way. At the beginning, for new big infrastructure requires a huge amount of capital, it's a capital play. But the capital is an IQT play. But IQT need to really bring the debt and the investors from the private sector capital, not banks' money, into the game. We're not there yet at all. Really, we're not.
And I mean, contributing to this is the thinking around sort of how is it that we can raise this finance in a logical way if you're talking about, you know, countries that are not China and perhaps, you know, sort of not the UK and perhaps not Singapore, who's obviously got a capital market that's already robust. But I guess maybe I can channel my inner Sean Kidney, which says we just need to go. You know, we need to make sure that these investments are green and sustainable and that we start getting some case studies and some really good examples of how it is that we're building this out in a logical way. And, you know, a couple of examples that come to mind. You mentioned that, you know, China has got a better credit rating, and so how does that get leveraged in? When I was sitting in Beijing in 2015 at the embassy going, all right, well, How does the UK participate when we're not even on the map for the Belt and Road? How is it that we can make sure that we get engaged here? And then there was a listing on the London Stock Exchange done by the Bank of China Hungary to raise financing for the Belt and Road Initiative here in London, in euros. And so all of a sudden you start thinking, actually, this is sort of bigger than just a point. Let's just start getting some of these products out there and seeing how it is that they can be used in conjunction with the MDBs, in conjunction with governments, and see how we can get some projects so that we can see how sustainable investment starts working forward. Other questions? Yes. Yes, sir.
Just to pick up on your point about the role of public finance to de-risk and to provide a cushion, etc. Do you see any of that coming from the Chinese government, from the money that's going to, being earmarked for One Belt, One Road through CDB or China Exim or anything? Is anything happening from that side, or this kind of de-risking area?
You want to know the truth? I mean, look, we all see part of the story, right? I mean, there's not every deal that we are all in. But the general sense is that they are definitely thinking about it, both in their domestic markets as well as their international market. Because they realize, as you rightly said, it's just not sustainable. I mean, look, if we are saying that we believe, according to your forecast or some other forecast, we talk about infrastructure needs like trillions, 57 or 90 trillion, which is quoted by the sustainable infrastructure, and the large demand comes from emerging markets. I mean, China's role is important, but the role that Chinese public sector money has quite a bit of a long way to go. Even the AIIBs, the new development bank, they just started. They need to work with you guys. They need to work with the established ones. They actually need to be out there and promoting it. And back to the basic point is that everyone talk about project list. I mean, everyone said, oh yeah, all the countries are actually working with you guys to publish those lists. Let's get it real here. If you really do your job properly, you will have investors coming in. If you do the structures right, you will have secondary markets. But we're working on it. It's going to be a slow burn. So hopefully we're picking the right battle. We're creating those big projects that set those examples for others to follow. And I will definitely download your monster report.
Great. Any other questions? Well, I think that one question that that hopefully we can wrap up on, and then we can pull this together, is thinking about sort of how big and how ambitious this Belt and Road project is, and how is it from the panel's point of view? I mean, we have Ada who's come in from Russia. We have Rico who's here from Hong Kong. I'm obviously a card-carrying member of the City of London. Goodness, I'm not sure where you are most days, wrong, but certainly, HSBC's got a patch. How does the global financial infrastructure, be it Singapore, be it Hong Kong, be it London, be it Shanghai, be it Astana, I mean, how can we all work together so that we've got a common language on a theme that is trying to draw together such a big patch of the world? Are there any comments from the panel about how we might be able to start thinking about doing that?
Maybe if I
Sure.
may, yeah. I mean, look, it's how we look at this. I mean, yesterday we had a similar session on this topic. I can assure you, half the people were asleep. I mean, they literally were asleep. Maybe they just... No, their eyes are wide open. Yeah, but the way we look at this is that, I mean, the train has left its station. I know some people find it so hard to accept. I mean, the name we were laughing in the coffee during the coffee break is pretty bad name if you think about it. I mean, it's really complicated as well, unless you go to the YouTube, which you totally remember by the little music, done by a cartoon person. But anyway, back to a serious note, we see this as a blank canvas. It's down to us to participate. At the beginning, we really think governments who are proactively promoting this and working with China and those recipient countries will be a beneficiary party. I mean, you talk about the UK's role. I mean, bless them, or bless all of us, thinking hard about how to work on that. Well, we said we can actually work with China as a third-party country, providing those services, etc. It's all very good, but how do we break into pieces? We really have to zoom down to those projects. So which country do UK have the best relationship? Let's go in there and let's really bring the UK leader companies like the Arabs in this world. I keep talking about Arab. I mean, I'm really big fan of them. Anyway, there are more of those like Arab that we can bring in, the professional services. Also on a separate note, this is our moment for banks, technologies and other providers to really get involved. The earlier we get involved, the better we can actually set a road that fits all of us rather than waiting to be told this is how the road is going. That's just my honest view.
Great. Ada, did you want to come in? And if I could just have a quick comment from both, because I think we're almost out of time.
Yes, just to stress the focus of the preventing the world going above the 2-degree increase is really renewables, I would like to stress. And there, a lot of parties could bring to the table things that we are reaching indeed 72% of renewable generation by 2060. That said, and by the way, the first 2 solar projects in Kazakhstan were done by a UK developer. So that just shows UK developer coming to Kazakhstan with financing from multinational institution, plus some Green Climate Fund financing, concessionary financing. Everything should be sort of put on the table. In the absence of formal coordination between all parties, it would be good just to start from early science, from early projects, just get going with it, start doing things across the world, even in the countries that might not seem ready yet. So Central Asia, Caucasus, that's the destination, Balkans.
Thanks, Ada. And a quick comment from you, Rika?
Yeah, Belt Road actually, at the beginning when President Xi threw out this idea, people confused, particularly the international community, thought, what is it? From the weird name. Basically, you can tell it's a Chinese Marshall Plan, Maybe it's true that China wants to expand its influence at an international stage, but indeed, infrastructure actually is what those developing countries need. So whatever you are involved or not, it's happening. I'm glad Sharon mentioned that London Stock Exchange actually is a very good example for the venue to list those products and to attract the money from Europe to finance those projects. So it's an opportunity to everyone. Particularly the UK is the gravity of the talents, money in Europe, and if you participate in those initiatives, actually you can benefit from it. So again, it's a big deal, and it's happening, and don't miss it.
Great, thank you very much. And I'm going to put a number on that big deal. 1.8 billion per annum to the UK. If you're involved in Belt and Road. So this is a number that was very recently estimated by a group that was led by KPMG, contributed very significantly to HSBC, the CBBC. I know they've got a rep here as well, and Juliet. And actually, I think that starts making it more tangible, that this isn't something that is going on in Asia. It's not something that's going on in China. It's something that we, as a global capital account, as a professional services center, really has some opportunity to get involved with. And if we don't do it with green as being the building block as to why it is that we're doing this going forward, a, quote, project of the century, as billed by President Xi, could also be a disaster of the century. So we definitely need to be able to take in the financing that's going on elsewhere, being able to make sure our influence is strong, and being able to make some money out of it as we go along. So, leaving that with you, I'd like to thank our panelists and thank you as an audience. Thank you.